Alrighty, hey everyone, and welcome to this event hosted by ICOA with guest speaker Shanis Windland. Shanis is the VP of Diversity, Equity, and Inclusion at VMware, and she's also a certified public accountant, and she'll be presenting today about asset classes and financial advisors. We're expecting the presentation to be about 40 minutes and then Q&A for the rest of the time, but it really depends on how it goes. So the rest of the time after the presentation will be the Q&A. So yeah, that's about it. I'll let Shanis get going.
Awesome. Thanks, Vanille. Really appreciate you having me here. So as Vanille said, I actually am working in HR now, a little bit of a career pivot for me, but spent my entire life doing accounting and finance roles where I was most recently the CFO of a tech startup here in Seattle that got acquired by VMware. So that's kind of how I ended up there. But I'm really excited to be talking to you all about investing. I love talking about money. I love talking about investing. And again, I've spent most of my career thinking about money and building money and managing money for startups. And I have to say this because I'm a certified public accountant, but I'm not giving investment advice today. I'm hoping just to help you all understand different options. So let's get started. Okay, so I think it's really important to make sure you're ready to invest before you start just putting money into investment vehicles and into assets. And this probably applies more for adults who might be kicking this off first, but I think the principles are the same for anyone who's interested in putting money into investments. It's obviously a great way to build wealth over the long term, but I do think it's really important to start with kind of the basics. So first, what are your goals around why you want to invest? There's so many different options. Are you thinking about, building wealth for retirement? Are you trying to save up for a down payment on a house? Are you thinking about short-term things like a big vacation or taking a gap year after high school, things of that nature? So being really clear about what your goals are with investing, I think is an important exercise to do before you start putting money into the stock market or other asset classes. And second, make sure you're not sitting around with a lot of high interest debt that you're paying on while you're trying to invest your money, because you're essentially depleting your assets and going backwards if you have high interest debt. And that offsets what you're trying to do from an investment perspective. And then finally, I think it is important to have an emergency fund. So a study recently said that over 70% of Americans don't have $1,000 in the bank. So I love that you all are starting kind of early thinking about this in the high school years, so that when you are adults, you'll be way ahead of most of Americans in money management over the long term. So let's jump into what are asset classes. So some classic, asset classes: equities, which are essentially stocks; bonds, which are where companies and governments will borrow money from people and pay a fixed interest rate; property, this can be residential housing or commercial buildings or vacation houses, lots of different options for property. Even in the UK, you can buy a parking spot and that can be an investment. So any kind of property, physical property. And commodities like precious metals, gold, silver, oil, gas, things like wheat, rice, etc. You can absolutely buy those physical things and hold them or invest in them through stocks. And then, of course, cash, what you need to actually buy things. These are kind of the key asset classes, traditional asset classes. But there's so many other options for investing too. There was a great article recently on Nike sneakers, how people are buying and selling them and making a ton of money. Art, a lot of people with, clear and deep knowledge of the art market. Not me. I'm not one of those people who buy and sell art and make a lot of money. Other collectibles, what about Legos, old Star Wars toys, and then of course crypto, something we're hearing a lot about with Bitcoin, Ethereum, etc. So really you can think of an asset class as anything that can go up in value. And so there's a lot of different ways that you can invest your money and make money. And I think it really depends on what you do the research on, what you might consider yourself an expert in, what you might have interest in. There's a lot of different ways that you might think about why and how you invest. So let's talk about building a diversified portfolio. So first, what is diversification? So diversification is holding a mix or a variety of investments. And the whole reason that you diversify your portfolio is to limit your risk. But when you limit your risk, you also will limit your return. So let's talk about a few recent examples in the stock market. I don't know, I'm sure you're probably on Reddit, but you saw this frenzy of people starting to speculate on GameStop stock. It started to go absolutely wild and went up hugely in value. And then it's come down and come back up and come down and come back up. So there are people who have a much higher risk tolerance than me personally, who went out and bought a lot of GameStop stock and made a lot of money because they were willing to put their money in a single stock and take on a high amount of risk. And because of that, they also made a high amount of money. I personally think of that as gambling and not investing. But again, that's my own personal view on it. It's not the kind of thing that I would really do. And then another example is Tesla. Tesla just took off like wildfire and went up, I don't know, 700, 800% over the last year, was up at about $850 a share, maybe even 900, and is now back down at $650. And in fact, I saw this tweet. This guy said that he had put all of his money in Tesla. And when it was at almost the top, around $900 a share, he had $11 million. He was never planning to sell that stock, and he was going to retire from his job, and he was done working. And I read that and was just like, wow, that's, I would never have the stomach to be able to do that. But he, was able, took a huge risk and obviously got a huge return. And now his portfolio is going to be down again because the stock's down. So that's the reason you diversify, so that you don't get jerked around by one asset kind of moving up and down, especially stocks that are speculative. And the thing about diversification is that you can be diversified across asset classes, within asset classes, or across geographies. So let's look at some examples of that. So let's say you own some property, and this is actually the case in Washington and around, a lot of cities around the United States. Housing is absolutely booming right now. So people's housing prices are going up, 10, 20, 30% year over year right now. But in this fake scenario, the stock market is not booming. Also not the case right now. Both happen to be going up at the moment. But you'd be diversified because, maybe if your house is going up in value, but the market isn't, you don't have all of your money going down in value. You've got some money that is appreciating. Another example might be you are all in stocks. You don't have any other asset classes, but tech stocks are up and pharmacy stocks aren't. So you're making some money in some areas and maybe not making as much money in others, but that risk is spread around so that you're not entirely losing or gaining money based on what one company or one asset is doing. And another example would be geography. So you might have some money in the Chinese market. You might have some money in the US market. And so as one country is doing well and another is not, you're also diversified across all of those different things. And, diversification can, be across so many different things, many, many more examples of how you can move your money into lots of different buckets to diversify where you're investing. And really, this is, all about where you sit on this risk scale. So as you have lower risk, you also have lower returns, and how you have higher risk, you also usually have higher risk, higher returns. So where do you put yourself? And there are a lot of different online quizzes. You can Google this, like a personal risk, quiz. And it'll help you kind of determine for yourself, how you feel. One of the questions I've seen is like, if you're watching your money and the stock market goes down, how do you react? Do you sell immediately? Do you hold? Do you buy more stock? That will help you kind of determine your own risk tolerance on how you feel as you watch your own assets go up and down in the stock market, because it will happen. It will go up and it will go down. And hopefully over the long term, it goes up. And in fact, history has shown that it always does, but in the short term, it doesn't always. So I think it's important to kind of determine your own risk factor. So let's talk about stocks. We're going to dig in on this equity asset class piece. Where can you buy stocks? So we know that stocks list on the different exchanges in the United States, like the NASDAQ or the New York Stock Exchange, but you don't have to travel to New York to buy them on the exchange. There are these companies called brokerage firms, and what they do is they connect the buyers and sellers on the exchanges to facilitate a transaction. And then they make money on commissions or fees from the buyer or from the exchange. And again, I don't know how many of you were following the Robinhood and GameStop story over the last 2 months. I found it to be absolutely fascinating. But Robinhood was making money off of GameStop by buying the stock at a slightly lower price than people were buying it from them for, and making money on the spread. And had to stop trading at some point because they literally ran out of cash and weren't able to do it. And so most of these brokerage firms are making money, are not charging fees on buying and selling stocks. They'll let you trade for free because they're negotiating on the back end with the exchanges to make a small amount on the transaction. So that's how they're making money. And this is just a sampling of a few of the different places that you can buy stocks. Robinhood, as I mentioned, kind of a new player in the market, up and coming startup. I think they're going to IPO soon. Fidelity, Vanguard, Schwab, and E-Trade. And each of these firms will offer kind of different products that you can buy or sell, and different levels of customer service. So it really just depends on what you're looking for from your experience. But there's lots of different options for where you can who you can use to buy stocks. So there's also a ton of different ways that you can buy stocks, and we're going to dig in on each of these next. So hedge funds, index funds, individual stocks, ETFs, mutual funds, and robo investors. And I think this covers the majority of them, although some of them get more complex from there, but these are kind of the high level buckets of how you can buy stocks. But before we get into that, I want to talk about sort of the types of investing that each of these are. So there's kind of five ways you can think about investing. The first one is passive investing. So what you're doing in that case is you're buying a bucket of stocks and you're saying, I'm not really going to think about what stocks are in this. I'm just going to buy them. And I know that it's a bucket of stocks and it's not really managed. I just buy this index or this fund and boom, the stocks go up or down, and that's my risk. Or there's active investing, which is where there's typically a hands-on approach, and we'll talk about what fits in this active investing bucket, by a manager or other so-called active participant. Then there's robo investing or a robo investor, advisor. And that's where there's an investment management that's online with moderate to minimal human intervention. So it's really AI driven by software. And there's some examples of how you can do that as well. Then there's DIY. So that's where you do your own research, you pick and choose your own mix of assets, and you decide when to buy and when to sell, and what companies to buy and what companies to sell. Really up to you. And then finally, there's a financial advisor. And that's where you're going to go out and get some professional help on picking and choosing your investments and managing your money for the long term. And there's plus and minuses to doing that as well. So let's dig in on each of these. Passive management. So this is the least expensive option for buying a bucket of stocks. Just want to make that clear. And there's a couple of things that fit into the passive management type. The first is index funds. So what is an index fund? So an index fund offers really great diversification of your money. So going back to that point I was making on diversifying, it's a bucket, a group of a bunch of different stocks. And it's designed to track the performance of an underlying stock index. So that might be something like the Dow Jones Industrial Average. So you would buy an index fund that has the exact same stocks in it as the Dow Jones Industrial Average, and it would just have those same stocks in it. No one will decide to take stocks out of that bucket or put stocks in that bucket unless the Dow changes what stocks are in its bucket and not in its bucket. And these index funds are very cheap. They're about 0.015% to 0.04% fee. So essentially, out of all the money you have in there, you're paying a portion of it to the people that put this fund together and allow you to buy it. And they allow you to own tiny pieces of hundreds or thousands of companies in one investment. So a really, really great way to diversify what you're buying. So you just buy this one index, and this index already owns a lot of different stocks, and then you are diversified. And you could buy several different indexes that own different types of stocks, and then you'd be even more diversified. And it's very easy to track because you just sell in and out of that index instead of selling in and out of the hundreds or thousands of different stocks that are in the index. And, as I mentioned before, this is a staple of passive investing because you are not doing any stock picking. You're just buying the fund itself. Another great example of passive investing is an exchange traded fund. And so these can work like an index fund, but the way that I like to think of them and the way that I differentiate them is that usually exchange traded funds are for a particular type of asset. So they are also owning a portion of a bunch of different companies, but they might be targeted towards pharmaceutical companies as an example. So an exchange traded fund puts together a group of pharmacy stocks, and you buy the fund, which owns a bunch of different pharmacy stocks. Or there's tech stock exchange traded funds. So it might even be big tech. So it would have Google and Amazon and Tesla maybe in them. So they would own some portion of a bunch of different tech stocks. And so I'd say they're more targeted, more tailored investment versus the index funds, which are a much broader group of stocks that are in them. And again, when you're trading these, it's really easy. You're just buying or selling that exchange traded fund as the underlying stocks in the fund are making money. And so it's much easier to just get into a diversified portfolio, but again, more targeted. So you might just want to be in tech stocks and pharmacy stocks or hospital stocks or whatever it is. So you just buy those exchange traded funds and you don't have to worry about buying and selling those individual stocks themselves. And then again, they're really designed for individual investors and also really low fees because they're not really actively managed. Again, It's like someone just puts together all the big tech stocks. And as long as that company exists, it stays in that fund, and the fund just kind of runs rather than being managed by somebody. All right, so next, let's talk about active management. And these are more expensive options for buying and selling stocks. The first one is classic sort of way called a hedge fund. So this is actually a limited partnership where you're buying into a fund and you're a partner in a fund. And these are usually a person is managing this hedge fund. So it might be a really famous investor who knows all about the stock market, has tons of detailed information, and has been proving that they can make money over the long term. But a lot of times these hedge funds aren't even open to people unless they have a certain amount of wealth or annual income in order to even get into these funds. So they're really not generally available to regular people like us to get into. And the thing about hedge funds as well is that they often employ a large amount of debt. So when you're in a hedge fund, the general manager has set out a strategy for how they want to manage this fund. And it's really them as a person making that decision and saying very actively, I like this stock and I don't like this stock. I'm going to bet against this thing and I'm going to bet for this thing. And, they do have the same sort of aligned purpose of maximizing your returns, because the way that they get fees is usually you pay them 2% management fee, and then they also get 20% of any gains. So the thing about the hedge fund is that you're very aligned in your purpose in terms of what you want to get out of this. You both want to make a lot of money from the hedge fund, but whether or not you make money is really based on whether or not this general partner is any good at timing and picking and researching the market. And so again, active, obviously people have made a lot of money in hedge funds over many years, but not necessarily an accessible way to access money. The next thing is a mutual fund. So a mutual fund is similar to a hedge fund, is that it's, you put a bunch of money into the fund, and then the fund manager decides how to invest that money. But it's usually offered through a brokerage like Fidelity or E-Trade. They might have their own particular mutual funds that are managed by a particular person. And again, the whole point is for them to make money, but they don't get paid the same way that a hedge fund does. And hedge funds are usually separate entities, as I said, partnerships that you're investing in, whereas a mutual fund is usually a more public opportunity. So again, investors put their money in and the manager decides where the money goes. So they might do bonds, they might do real estate, they might do commodities. And you can look up in the prospectus, which tells you all about how the fund makes decisions, and you can decide if that's the kind of investing you like. You can look at the fund manager's history and you can say, hey, this person has managed to beat the market over the last 10 years. I think that I want to put my money in them. But with mutual funds, they're not usually tied to a partner. So if somebody works at Fidelity and they're a mutual fund manager, and then they quit their job and they go work at E-Trade, then a new fund manager would come in and they might not be as good at managing the money and pulling it in and out of the market. And again, it costs more money because they have to pay that person to make the decisions about what goes in and out of the fund. All right, so let's talk about robo investing. And so this is automated investing. And as I mentioned, it is AI driven and it's also less expensive. So what's a robo advisor? So what you do is you tell the advisor all of your personal preferences and your goals, like what's your risk tolerance? What are your financial goals? What's your time horizon? And then they essentially take your money and automatically invest it. And they will weigh, again, not they, the AI will weigh your personal preferences against unpredictable forces in the market. And one of the good things about these is they also will take into account like tax savings opportunities. So actually selling out when you have a loss to help you with tax harvesting. And they're pretty complicated machines, and there's some big ones. Betterment and Wealthfront are the two biggest ones, with billions of dollars in assets inside of them. And the thing is that generally you put your money in, it's all driven through an app or a website. You are not making any decisions about what kind of assets they're buying when they're buying and selling in and out of other things. It's all completely AI driven, and you just watch the money get managed. So I personally think these are really cool, and utilize them myself for some of my money. And then finally, we have the good old do-it-yourself option, right? And so this is really where you're researching your own stocks on your own, and you're buying and selling as you see fit. And this is if you're super interested in understanding the dynamics of individual stocks, or you're really excited about a particular company, or you're super excited about investing in particular areas like, say, green energy or tech stocks or something, and you just want to like do some of that buying and selling yourself. But just know that in order to be diversified, you have to buy a lot more stocks individually. That the risk is higher when you're buying and selling individual stocks, because you're betting on a particular one outcome versus many outcomes, as works in the funds. But can also be a great way to learn about investing and building a portfolio. So there's pros and cons to all of it. And then finally, you can go and find an advisor, a financial advisor. And before you do, you should really think about what level of help you need. And is there a specialty you need? Like, a lot of times as people get closer to retirement, which you all are obviously a long way away from, which is good, they might want someone to help them kind of transition from being riskier to less risky as they move into retirement planning. Or they might want someone who really specializes in building wealth for future generations. Like, it really just depends on what you need from a financial advisor. Or it's like, I don't want to deal with any of these things. I want somebody else to make all the decisions for me, and I would like to just give you access to my money. And so they obviously charge a fee for any money that you have with them or with their institution, and those fees vary, because it's kind of like having your own individual hedge fund manager. They're making decisions about where your money goes for you. But I really would recommend if you're going to think about getting a financial advisor, to get a certified financial planner. And with a certified financial planner, this is a designation given by the state. They're required to have fiduciary duty for you. And that means when they make decisions, they have to make them in the interest of the client, not in the interest of what their fees are or how much money they're going to make. Someone who sells life insurance, they make money by selling you life insurance. So they don't have a fiduciary duty to not sell you bad life insurance. But a certified financial planner, they should be working for you as the client. So I'd really recommend getting a financial advisor who has that designation. And then when you go to talk to a financial advisor, if this is something you're interested in, make sure you really ask about fees. How do they get paid? And again, do they have conflict of interest? So if they're putting you in a particular fund, is it because they're making more money because they're putting you in that particular fund? Again, you want to have someone who's going to help you make money for you and not for them. And then finally, just something to think about. How do you want to work with your financial advisor? Some people want to go in and sit down with them and go through all their money. Some people just want to have access to a website or a tool or an app and go from there. So it really just depends on what you're looking for from the relationship. There's all kinds of other things they can help you with: tax planning, just overall financial planning, building wealth for future generations. So as you get further down in your investing, something you could think about getting kind of professional help for. So that is it. And I only went 30 minutes. So we have 30 minutes for questions. And, I'm happy to take any questions any of you have across any of these topics. I'll stop sharing my screen.